Good morning, everybody. Welcome to Friday, as always. I'm looking forward to our session today. Before I do anything else, really quickly, because of some technical problems we've had with previous sessions, I just want to double check really quickly and make sure everybody can hear me. If you can hear me, please go ahead and just mention that in the chat, just to confirm that I don't have any technical issues that I have to try to resolve right now before we move ahead. I'd really appreciate that. Thank you. All right, can you hear me? Perfect. Thank you, Gib. Appreciate it. That's awesome. That gives me what I need. Hopefully, we'll get a few more people coming in as we get things rolling. But in the meantime, we'll go ahead with what we've got. And as always, I'm looking forward to this session. We had, of course, the market was closed yesterday for the New Year's Day holiday, but we're open this morning and off and running. So there's always plenty to talk about. This is the first Friday of the year. That does mean that there are some options that are expiring today, and so that means there's always something to talk about. Now, I don't have any open positions that are set for expiry today. All of mine are all of my currently open put sales are scheduled for the next couple of weeks. But that doesn't mean that we don't have opportunities to look at those stocks. So we're going to be going through those trades. I believe we'll also have some opportunities to go over some other stocks that some of you may be interested in as well. So let's go ahead and dive in. One of the things that I want to try to make sure to do today is to those of you who have been part of this live stream before, you know that I talk quite a lot about position sizing, but I want to try to frame each one of the positions that I'm looking at today in context of the way that I have set up those positions from a management standpoint. Now, this isn't just about whether or not you're trading more actively or you're taking a more conservative approach like I do. This is about trying to think about not only how much return you're trying to generate in every single trade, but also how much risk you want to take. So, one of the first things that I want to talk about is, give me just a second here. I'm going to pull up a document. One of the first things I want to do here is just kind of put position sizing rules in context. Position sizing refers to how much of a given position you're going to be putting into any single one trade. The point of this is it really comes down to a couple of things. For some people, this is about trying to diversify your portfolio as much as possible. But more importantly, this is really about trying to manage risk. Diversification spreads risk across a lot of different positions. But really what I'm wanting to do and what I'm trying to do on an active basis with every single trade that I am placing is I want to manage. I can't eliminate. I can use the word minimize, but I'm not exactly sure that necessarily applies either. What I want to try to do is manage the amount of risk that I expose my portfolio to in each trade I place. Okay, so under normal circumstances, the first rule that I've usually used, and again, this is just to try to be as conservative as possible, is to allocate no more than 5% of my total account value into any one trade. Now, my my portfolio right now, is around $300,000, and that means that that if I'm wanting to manage this the way that I'm talking about, that means that no single position should take up more than $15,000 of my account. Now, this is the broadest and first rule I use under what I consider to be categorically bullish conditions, and this allows me to make sure that I've got up to about 20 positions in play at any given time. Lately, and actually for the last few years, I've been shortening that. If you want to be even more conservative, oops. All right. None. There we go. If I want to be even more conservative, I'll call this just rule 2. More conservative. Cut that number in half. So 300,000 times 0.0. Let's go ahead and just say 3%. Equals. So that means that now my allocation is no more than $9,000 per position. Again, lately, I've been going even more conservative than this. And I've been doing no more than about 2%. So that's about $6,000 per trade. As much as possible, most of my trades are falling between 2 and 3% of the total account size right now. And I really don't want to go much more than that. That's again, this isn't about trying to diversify more. This is about trying to make sure that that I am managing risk in every single one of these trades. And as we go through this, one of the primary reasons for me for doing this is because of the way that I approach put selling. Remember that when we sell a put option, we're talking about giving the option buyer the right to sell the stock to us at a set price. If the stock is in an upward trend and the stock closes above the strike price that we've sold at expiration, then the option expires worthless and we can move on to the next one. If the stock is above the strike price we've sold in the weeks leading up to expiration, we may have an opportunity to close the option by buying it back at a lower price than what we sold the contract for initially. So there's a lot of reasons that the put selling trade as an income generator is really practical and really useful. But the reality is that when you are selling a put option, that right you're giving to the buyer to require you to buy the stock at a set price does expose you to some risk on the downside. If the stock has dropped significantly below the strike price that you sold at expiration, then there's a paper loss that you have to be willing to absorb between the price that you're buying at and where the stock's price is at right now. People might ask, why would you be willing to do that? And so I'm going to go ahead and open that up. I don't want to just be talking too much here, so I want to try to get some conversation going. Why would I want to? Why would I give somebody else the right to sell to force me to buy the stock at a price that is above its current price? Let's use as an example the trade that I placed this week on Occidental Petroleum. I sold the $41 strike price, and I brought in a little over 2.5% for this for a 3-week trade, which is very practical from the standpoint of income generation. That works out really nicely. But this $41 strike price becomes really critical. If at any point in this 3-week period the stock drops below 41, I could be assigned shares of the stock. So with that in mind, why would you want to do that? Why would that be a trade that you would be willing to make? Go ahead and put in your comments about what your own reasons may be, or if part of what you try to do with your method is to avoid assignments. That's also an acceptable answer, because this is all about trade management and risk management. Yeah, thank you, Barry. I appreciate that. You believe it has a higher upside based on your analysis, and that's absolutely true. My value analysis for Occidental puts its long-term target price much very well above $41, which means that even if the stock does close below 41 within the next 3 weeks, if at expiration it's below 41, I actually don't mind taking that assignment. In other words, 41 is a price that I'm actively saying that I'm willing to buy the stock at. Gibb says, I don't want to buy, but I will if I have to. So I set my risk at 2.5%. Right. That way you can play with the strikes, but my risk is set. I love that. Go in ahead of time with a set amount, and then depending on the total size, right? Because this is going to be something that the total exposure, the total amount of dollars you have to reserve in your put selling trade can and does vary depending on the price, the strike price that you're selling. This is the number that your broker uses to set what is known as your reserve requirement. The reserve requirement can be total of cash in your account if you're working on a cash secured put selling basis. It can be margin if you're doing it exclusively on margin. To be honest, that's not something I recommend, but some people do it. Or a combination of cash and margin. So what that means is that for this Occidental trade that I placed on Wednesday, with the $41 strike price in mind, that meant that any number that I wanted to work within needed to fit within the 1 to 2% threshold that I'm setting for my trades. So, let's get rid of these. So if I'm trying to work more conservatively and not have more than 2% right now, $6,000 is the maximum allocation I could have. So I sold the $41 strike price that expires on the 23rd of this month. Got to remember to put in 2026, not 2025. We are on a new year now. So that means that the reserve requirement is $41 times the number of shares associated with the contracts I sell. Okay? So if I want to stay within $6,000, let's say I just want to play with the math a little bit, so I can do 41 times, well, maybe I can do 300 shares. Oops, no, that's $12,300. I've got to do only 6,000. Now I can't do partial contracts. Every contract I sell controls 100 shares. So it means I also can't do two contracts because that would be a total reserve requirement of 8,200. So that number, 8,200, would fit in if I wanted to expand my exposure to up to 3%, which is this $9,000 threshold. And even the 300 contracts would fit into a 5% threshold right now. Barry already had to put on Oxy. Yeah, that's true. You're the one that clued me onto this stock, so I appreciate it. Thank you. He said I already had to put on Oxy for 40, so I went ahead and bought a lot on Tuesday and sold a call. So you bought 100 shares and sold a call on it, which is awesome. There's a good covered call trade for that one that was available as well. So if I wanted to be a little bit more aggressive, and when I say a little bit, I'm not saying that a 5% allocation is aggressive. It's pretty conservative. I am going even more conservative right now. I'm trying to stay within 2% and actually in many cases even less. So that means my maximum size in the trade right now is $6,000. That's what I was willing to do for this trade on Occidental. So really that means $41, times 100 shares, that would only be one contract, creates a reserve requirement of $4,100. This is the amount of cash or margin, or a combination of both, that I need to keep in place in my account for the duration of the trade. Okay? This is the amount that is required to fulfill the potential obligation of being assigned the stock. So as long as I have that in place, I'm clear. And again, this is where the understanding of the possibility of being assigned becomes really important. Not everybody that works with put selling wants to be assigned. I actively don't. I actively take that as a very real possibility, and I don't avoid assignments. This reserve requirement becomes important, even if you don't want to take those assignments, just because this is the amount of money you have to be able to keep track of in your account in order to meet your basic broker requirements for cash and margin reserves. So, excuse me. This ensures that you will be able to manage any potential obligations that may be associated with them. This is true no matter whether or not you are accepting assignments or you're taking a more active trade approach, or possibly you're buying the option back before you take any big assignments. I hope that makes sense. These are the basic rules that I'm following, and as far as what recommendations I give to new people who are joining Rebel Income is usually to start with this 5% increment, no more than that, and then if you want to be more conservative, like I am, or like Gib is doing, then that's awesome too. So whatever fits into your overall strategy is going to be important. The reason I'm bringing this up right now at the very beginning of today's session is because I see a lot of people very often when they start working with put selling, they want to try to maximize the amount of income they bring in every single trade, and so they over allocate. Uh, they create an over allocation in their account because they sell too many contracts, and then they become hamstrung and surprised when they can't place any more trades, and when their broker starts giving them things like margin calls because the stock has moved against them. So this helps to manage those possibilities, and it also helps to frame the exact amount of risk that you're taking in a practical context. This $4,100 becomes really important to think about when I consider the reality of taking a put sell assignment. What if the stock is at $30? It's not going to be very likely, but let's say that the stock really tanks, and this is a 3-week trade that I placed. What if on the day of assignment it's at $30? Well, I'm going to take an assignment, and my shares are only going to be worth $3,000 in that case. That's a lot less than $4,100. That's a big deal, to be sure, but in terms of thinking about it as an allocation of the amount of money that I have in the account, it becomes a lot easier to think about in practical terms, because I have created I've created a total allocation that is a lot more conservative, and I can think in more practical terms about whether this is a situation where I'm going to be willing to ride the stock out and try to let it come back over time if the fundamentals are still holding, the value proposition is still high. Then I tend to ride through these downturns, and that means that sometimes I do take assignments and I stay in a stock for an extended period of time. And when I say extended, sometimes it's a year or more before the stock comes back to the price that I was assigned at and offers an opportunity to start selling a covered call. That's not the case in every single one, but these are the things that I want to try to think about right up front as soon as I place a trade. So this is one of the first things that you have to do anytime you start placing a put selling trade. Think first about how much of your capital you are allocating into that trade and what that means in terms of the overall possible risk that that money may be exposed to. Trying to limit that amount as much as possible is going to help you sleep better at night. It's also going to help you make more objective decisions and to be more practical about whether or not you need to make changes to the approach that you're taking. And usually, when I say you need to change your approach, it usually means changing your position size. Usually means that you've been taking on too much risk with position sizes that are too large. Okay, I hope that helps. And if you have any ideas or rules that you set up on your own here that you'd like to share with the group, I'd love for you to post those in the chat as well. But those are some basic rules. So now I want to go ahead with that in mind. Let's go ahead and talk about the actual trades that I have that are open in the market right now that are ahead of expiration. A lot of cases, I usually have a trade or two that is set up for expiry on the day that I have the live stream. And so it's an opportunity to look at whether or not I'm going to be taking assignment on those. I don't have any of those right now. Everything that I have right now is set up for expiry within the next couple of weeks. So we're going to start with this put sale on Coterra Energy. This is a trade that I placed in the middle of December. I sold the $25 strike price and brought in about 1.6%, and I sold 3 contracts on this. This is important. Selling 3 contracts, again, when we talk about position sizing, I just said that the rule I set for Oxy was to try to limit my exposure to no more than 2%. Well, with CTRA, sold 3 contracts, which is 300 shares at 25. So that means my reserve requirement is $7,500. So $2,500, since that's $2,500 would be the amount for one contract times 300 shares. So this one is a little bit above 2%. So this is 7,500 divided by 300,000. So this is more like 2.5%. So I'm getting in between that 2 and 3%, kind of like what Gib is doing right now. Gib says, do you have an assigned to expired ratio for your trade? For your trades, probably about 25% of the time is about how often I get assigned. So I would say that these trades expire more often than not. But I also manage my trades. I manage every single one of these allocations as if I will be assigned, as if my assigned ratio is going to be 100%. I hope that makes sense, Gib. I try to plan with the expectation of being assigned, not with the expectation that they're going to expire. But the overall ratio is about 25% of the time I get assigned. Okay. So that's the total allocation on CTRA. Let's go ahead and take a look at that stock and see where it's at right now. Remember, I sold the $25 strike price on this one, so that means my strike price is down here, and we can see the stock is nicely above that. It's been using the 200-day moving average, which is right around 25, as support. Fair enough, good. And it rallied up to a peak around 26.50 to start out the week, and is traced back a little bit, but is still above 26.13. So I'm a couple of weeks to expiration, and it looks like this is in a pretty good position right now. I'm pretty comfortable with this $25 strike price. And again, even if I am assigned, even if I look at the 52-week low for the stock here, it's down around 22.50. And so this doesn't really create a whole lot of fear if I am assigned, because the stock is below 25. The dividend for these guys is more than enough to make it worth the time. Right now, it's a little over 3% of the stock's current price. It's more than enough. This is the other reason that I don't avoid assignments, and why I do plan every trade as if I'm going to be assigned. I only work with dividend-paying stocks, and remember that. And so the income that comes from those dividends becomes a passive income source that factors into my overall long-term results. So as of now, things look good. That does mean that there's an opportunity to look at that current contract and see if there is possibly an opportunity to manage it a little bit more actively. Some of the people that have been in our Rebel Income community that do work on a little bit more active management approach, I take what I call a pretty passive approach. I sell a put option, and then the result at expiration is the result. If I'm assigned, I'm assigned. If the stock is above the strike price I've sold, it expires worthless, and that's fine too. A lot of people don't want to take that approach, and so their method is to consider whether or not there are opportunities after you've sold the put option to buy it back before expiration at a discount relative to the premium you brought in. So what that means is that I take this 40-cent premium that I brought in as my reference point for my day-to-day evaluation, as well as the $25 strike price that I sold. With the stock above 25, now I can look at the asking price of the contract on a daily basis. Remember, time decay. One of the reasons that I sell very short-term expirations, this is really one of the primary reasons, is to take advantage of the time decay element associated with every single option contract that ever exists. The last trade on this was 15 cents. A lot of our active rollers, that's the term I use for people who tend to manage these a little bit more actively, they will generally try to, they'll look for opportunities to buy the option back. They'll set a buy to close order if the asking price is 50% or less of the premium they brought in. So right now the asking price is 15 cents relative to the 40 cents that I brought in. That's certainly less than 50. So that means that if you wanted to avoid the assignment, you could, by setting a buy to close order right now. If you didn't want to monkey with the difference between bid and ask at all, if you were just trying to manage this trade as actively as possible, go ahead and set a buy to close for 15 cents. There's enough open interest here, even though there's been no volume yet today. There's enough open interest that I'm willing to bet that trade would be taken fairly quickly. Now, that does lower the amount of premium that you brought in for the trade, but it also shortens the trade duration. This is a trade that I set on the 17th. This was a 30-day trade for me. So that means that if I were to buy this back right now, that means my trade duration would go from 30 days to 16 days. That would also mean if I paid 15 cents to buy it back, that I would hang on to 25 cents of the overall premium, which is obviously 1% is the total income. Now, maybe to you, you look at that and go, that doesn't sound like much. Why would you want to do that? Well, again, remember, this is the difference between 16 versus 30 days. Remember, part of the reason that we're selling, the other part of the reason that we're selling very short-term contracts is to set up an opportunity to compound our results over time. Well, if I'm selling a contract every 30 days with the $7,500 that I put in reserve on CTRA, that means that I'm going to basically be placing 12 trades, which shouldn't surprise anybody. Right? 12 months in a year, that means 12 trades. Okay? I brought in 1.6% on this. Now, if this trade expires worthless, then that means that on an annualized basis, I multiply, well, yeah, let's just keep that at 1.6. That's fine. That means that if I can do 1.6% every 30 days, I can place 12 trades. That means that my annualized result for that money is about 19.2%. I'm good with that number. My target is about 1.5% per month. So if I want to be a little bit more active about that, what does that do? If I buy this back and I give back a little under 50% of the premium that I brought in, well, as we mentioned, that was going to be 1%, right? 0.25 divided by 25, 1%. But if I'm doubling, if I'm going from 30 days to 16 days per trade, keep that 1% in mind for now. Now, my trading frequency, instead of 12 trades, goes to 22, not 24. That's I can't round up that in that simple terms. I'm also not going to go with 23. I'm always going to go with the lower number round down. So that's 22 trades. That means that instead of the 19% that I'm doing on an annualized basis by letting the option expire worthless, I'm going to hit about I could do about 22%. So I expand my results by about 3%. Again, if that doesn't sound like a whole lot, I get it, but it actually the difference between 19% and 22%, when you can do this over and over and over again over time, if you're the difference between 19 and 22% on a yearly basis really starts to add up. And so this compounding element of these income trades that you place, when you can place more trades and increase your trading frequency, you get you can expect generally to achieve higher results. Okay, this also minimizes and manages that potential risk of taking an assignment, because as soon as you buy the option back, that obligation is eliminated. You can then decide if you want to continue to work with the same stock, take that same $7,500, for example, and maybe I consider rolling forward in time and up a little bit. The stock is up above 26 right now. So that means the 27 is the first is a little bit in the money. And for Coterra, there's not enough open interest here to really, this one, I'm not sure that would be worth it, because there's really not a lot of open interest and certainly no volume going on here, even for about a month. So in this case, it would probably mean taking that $7,500 and looking for a new trade. You could work at 27 if you wanted, but the stock is actually below that price right now. So selling an in the money put would be pretty aggressive. This isn't a recommendation to buy or sell. This is just trying to think about how to try to manage your trades. I hope that helps. Anybody else have something similar with CTRA that you're doing? We already talked about Occidental a little bit. Let's take a look at that one. I use that to set up my discussion on portfolio management, but let's actually look at what the trade stock is doing right now. This was a 3-week trade that I set up, selling the $41 strike price, bringing in $1.06. And it's just a little bit above that price right now. I'm only a couple days into it, actually 1 day since the market was closed yesterday, and I placed the trade on Wednesday. So there's really not much of an expectation that there's going to be a lot of movement from this point. So not really going to worry too much about whether or not what the difference in the current price might be for this contract. Here's what I mean. I sold the 23rd. Brought in $1.06, and the current bid ask on this is 93. So that's 1 day in. Had 1 day's worth of 2 days worth, excuse me, of time decay. The nice thing about time decay, remember, is that it takes place whether the market's open or not. So even on a holiday where the market's not moving, or a weekend, you're still getting that time decay element working for you. That's why one of the reasons why the asking price is a little bit lower right now. Barry, had Oxy been closer to the $40 strike, I would have waited until it expired before you made another trade. Fair enough. and you did feel pretty confident to open the new trade. Yeah, and again, if there's an opportunity, this is one of the reasons that I like taking assignments. And I think about every one of these trades that I take as opportunities to build my portfolio. Um, I also set up opportunities to pay myself dividends, just like Barry did with covered call trades. So, yeah, Barry, I like the fact that you decided on a little bit different variation for the trade as well. So I think that's awesome. Okay. So that's Oxy. We've also talked about CTRA. The only other trade that I have in play right now, not exactly in play, but the only put selling trade that I have on deck that hasn't expired yet, that's really what I mean, is this put sale on Target. Now on this one, my portfolio, my position sizing went a little bit larger. I sold the 92 contract for 23 days and brought in a little over 1.68% on this with that $1.55 premium. Now, again, thinking about position sizing, this $6,000 rule, this conservative rule that I set is not hard and fast. This is fluid. I take this on a trade by trade basis. And so selling Target, sold one contract or 100 shares at 92 means 92 times 100 is a $9,200 reserve requirement. So it's a little bit above 3%, but I'm also calculating a little bit lower than my actual account value. So I was okay with this. This is still pretty conservative, and I'm below 3%. So as much as I can, I'm trying to stay below 2% on my allocations. But that's not a hard and fast rule, depending on the stock and the opportunity, especially if we're talking about something that is a little bit higher priced. I may be willing to stretch that allocation rule a little bit. However, this is still my top line position sizing allocation that I'm willing to take. No more than 5%. So for this one, I accepted 3%. Again, this is when we're talking about trade management. These numbers don't have to be hard and fast rules. You just have to be making sure that you're doing this evaluation on every single trade so that you can decide if you think an adjustment or a variation is appropriate. And if you decide you do want to treat these as hard and fast rules, I'm going to say, okay, go ahead. There's nothing wrong with that either. I'm willing to let mine flex a little bit from one trade to the next. So with this one, selling one contract, Barry says, come 116, I will either have a few additions to my portfolio or will have a significant capital infusion, have 6 open puts for that expiration. Amazing how that kind of stacks up sometimes, isn't it? Yeah, I had that, didn't have the same number that you're talking about, Barry, but in December, I had 3 positions all stacked up on 1219 between put sells and covered call trades. I've at different points in time, here's October. I've had 3 or 4 at any given time, quite a bit. So again, that's not necessarily a bad thing. Just make sure that on every single one of those trades, your allocation is manageable, right? Yes, if you're willing to take some of those additions, then that's awesome. Obviously, a little bit of expansion of your capital flexibility is also a nice thing. Assuming that maybe the put sales expire worthless, right? Okay. So again, going back to target here, I've got a $9,200 allocation for about 1.68% return for basically a 3-week trade at the time. It's now about 2 weeks to expiration. So on target, remember I sold the $92 strike price. That's all the way down here. And the stock is obviously showing some nice momentum. It's got some topside resistance here at around $100. But now that it's actually pushing above the 200-day moving average, and it's been, if you look at the 200-day moving average, you know, it's starting to, not only is it starting to flatten out, but the stock is really starting to consolidate around this level. The 20-day moving average is crossing just a little bit. So you're getting some convergence between these two moving averages. This is a pretty favorable technical setup from a bullish perspective. So even if we see some consolidation where this $100 resistance continues to hold, we should have pretty strong support. What is this? Probably at about 94. That means that my $92 contract that I sold, I feel like is in a pretty good spot. And even if I am assigned, I really like that price. The stock's 52-week low came in November, probably at about 83 and change. I'm really not too afraid of that, though. And again, if the stock is below $92 at expiration, then I'm going to go ahead and take that assignment. That's fine with me. But this distance between 98 and 92 does mean that with a couple of weeks to expiration, there's probably some opportunities to think about this on a more active basis. Remember, I've only been in this for about a week. Okay, 14 days to expiration. I've got to expand my strike prices here. Let's go to 12. Nope, 16. All right, this is the one I want. There we go. The buy to, buy to close on this is 65 cents. There's about 16 cents difference between the bid and the ask prices. Means that there's probably not a ton of activity. Yeah, about 5 contracts in volume so far. Plenty of open interest going on here, though. Now, remember, I brought in $1.55 here on this trade. So, if I think about $1.55, if I buy it back, the ask just changed to 63 cents. Apologize, got really bad hand writing going on here. So $1.55 minus 63 cents, that leaves 92. Which also, you know, again, this would be obviously 1%. If I were to buy this back right now, Barry says, on my IRA account, I have cash only, so I don't get into trouble since I'm taking larger positions. Yeah. And most brokers, if you're working in a qualified retirement account like an IRA, if they allow put selling, not all brokers do allow put selling in an IRA, but if they do, they will, in all likelihood, only allow it on a cash secured basis. To be honest, I prefer working cash secured as much as possible. I just don't want to deal with the complications of dealing with margin interest, potential margin calls, yada yada yada. So, but not everybody does. Not everybody agrees with that. And if you're using a combination of margin and cash, that's okay too, as long as you're taking those extra risks into account on your trades. So this is 1%, but again, I'm what I would be doing by buying this back right now is dramatically accelerating my compounding effect. Let's remember that what I brought in $1.55, which is 1.7, a little under 1.7%. That sounds better than 1% to be sure, but this was a 23-day trade. So you think about this in terms of trading frequency. That means I could place up to 15 trades per week. Now, again, this is a more than adequate result for me, because if I can do this over and over, if I can do this every 23 days with the same capital, the same $9,200, that's a 25% net return on that $9,200. Perfectly acceptable to me. But if you want to take this more active approach, this is only 1 week into the trade. You can decide if 0.92, the 1%, let's see, 365 times, sorry, I got to think about this for a second. Okay, I set this trade on Christmas Eve. So 24, we're at 31. So this was a 9-day trade. If I were to buy this back, this would shorten my duration of my trade from 23 days to 9, which would expand the total number of trades I could possibly place to 40. Okay, well, in that context, is 1% for what is actually a 9-day result? How does that sound? Should sound pretty nice, because if you can do that again and again and again every 9 days, now you're talking about possibly 40% net return. Again, these numbers are simplified. The math is not going to work out this way every single time, because you're not going to be working with the same duration on every single trade. But this is a way to start putting the income that you're generating into a practical context. If you're trading more actively, you're working with this rolling method that I'm talking about, you're going to have periods of time where you're going to be doing this on just about as frequently as we're projecting here. And so these numbers, even though I say they're simplified, they're also fairly realistic. Okay. Now, if you do buy this back, that does beg the next question. What are you going to do with the money next? Are you going to continue to work with Target, possibly at a higher price? Well, here's 206 that's available, same expiration, still January 16, at the $98 strike price. If increasing the allocation by moving up to a higher strike price isn't something that is troubling to you, if it still fits within your the general position sizing parameters you've set for yourself, that's okay. Then this is actually pretty attractive. This is a little over 2% for 2 weeks. So implied volatility here has been picking up a little bit. $98, sorry. 2.1%. That's interesting. And if the stock continues to show positive momentum, if we get a break above this resistance level at 100, get one of these, there could be another opportunity to buy that back at a discount, kind of like we're talking about doing right now with the 92. Again, I'm showing these primarily for illustrative purposes, but really to start to hopefully put into a very real context what the possibilities are when you work with an income generating strategy like put selling, covered calls, all of these kinds of things. Okay. We've got just a few minutes left in the session, and we've gone over all of the trades that I have open right now. So in the few minutes we've got left, if there are any stocks that any of you would like me to review and go over, certainly be happy to do that. So you go ahead and put in the symbol for those, and if you want to share the setup that you may be looking at or maybe in on those trades, that would be awesome. And by the way, I really appreciate the conversation, the comments that you've been making, Barry and Gib here. This is a real important part of the way that our live stream is set up, is to try to make sure that we're encouraging an active discussion as much as possible. So I really appreciate your willingness to share what you've been doing with your own trades and what your own rules and methods are. And of course, if you don't have any stocks that you would like me to take a look at right now, we can go ahead and give you back a little bit of time from this session. You can certainly close this a little bit early as well. It is still New Year's Day holiday weekend, and so I hope everybody has fun plans with their families. For my part, I got to celebrate New Year's Eve a little bit early with my grandkids. Parents didn't want them staying up till midnight, so we did New Year's Day celebration at 8 p.m. We blew confetti and had balloons and all the rest of it. It was a lot of fun. But I hope you have a great weekend. And if there are any questions that come up between now and next Friday, we will be there. There's nothing coming up that is going to keep us from having the sessions on a regular, the normal weekly cadence that we usually have. So if you have any questions between now and next Friday, please don't hesitate to let me know. You can reach out to me on Discord, on Substack, and as well as sending me an email at rebelincomesystem@gmail.com. Barry, I'm sorry about Alabama. That is true. They didn't show up as well as you would have expected in their bowl game. BYU, I thought they were going to get spanked like a bad kid at one point, but they came back, and that was nice. Boy, I like Georgia Tech though. They were a good team. All right, guys, everybody, thank you so much for your time. I do appreciate it, and we'll talk again next week. Thanks. See ya.